So there's a tax loophole called the STR, short-term rental loophole, that people who make over 6 figures are using to pay zero income tax. And so here's how it works. You want to buy a property or an additional property. Let's just say it's $400,000. And then here's the key. When you operate this business as a short-term rental, it's not just a rental property, it's a business. Now this unlocks something called accelerated depreciation. And thanks to a new law that was just signed by the president last month, a cost segregation study will allow you to deduct up to 30% of this property on this year's tax return. So on this $400,000 house, that's $120,000 tax write-off. So in this example, if you were someone who made $120,000 in taxable income, this $120K deduction would wipe out your entire tax liability. You would pay nothing to the government. Plus, you now own an income-producing rental property. Now, this is completely legal, and thousands of people are using it to reduce or eliminate their taxes. Now, be sure to confirm with your tax pro on your specific situation, and please share this video with someone who wants to pay less money to the government.
Okay, this isn't a loophole. It's a real rule set, and people get it wrong all the time. So here's what he's talking about. If your short-term rental has an average guest stay of 7 days or less, the activity can fall outside of what's considered normal rental activity under the passive loss rules. That matters because when you're not automatically stuck with passive treatment, then you can potentially write it off. There's a Treasury regulation on this. I think it's 1.49 or 469-1T. An activity is not a rental activity if the average period of customer use is 7 days or less. That's it. It's a business. So the next question is your involvement in that business passive, or do you materially participate? Because that'll determine whether it's going to be passive or not. That does not mean Airbnb equals write-offs automatically, because even if you do a cost seg and bonus depreciation, even if you have a huge paper loss, it might still be passive unless you materially participating, meaning you actually worked in the activity enough and you can prove it. Logs, task times, keeping a time log. And if you have a property manager, cleaners do all the work, and you're just approving things on your phone, you're not going to qualify. And then there's the part of the reel that they usually skip. If you provide hotel-like services, you go up another standard and you're doing an Airbnb on steroids, you can trigger Schedule C situation, which means self-employment tax, and that can wipe out the benefits fast. So yes, short-term rentals can create big paper losses with depreciation and cost segregation, but the rules are mechanical. Average stay, services, material participation, documentation, and personal use limits. Do it right, it's powerful. Do it sloppy, it's audit bait.